if you want to go out and live that millionaire lifestyle, then you're probably going to keep this $1 million in cash in your bank. That way you can access it very easily. And now what you're gonna do is you're gonna go out and you wanna look good on Instagram. So you're gonna buy yourself, let's say, a $500,000 house with cash. That way you don't have to deal with any mortgage payments. And then you're gonna buy yourself a nice $200,000, maybe an Audi R8, a nice supercar. You're gonna go on a few vacations. So there's a plane, looks like a plane. And in a couple of years, you are going to be broke. So if you want to live the Instagram flexing lifestyle, then the $1 million is not going to last you very long. This should be pretty obvious. If you're subscribed to a YouTube channel, you understand that it doesn't really matter how much money you make. It's what you do with the money you make. Even if you have $1 million, you can go broke almost instantly if you don't know how to use your money the right way. And if you're not subscribed to a YouTube channel, you should do that. But this is why so many high-paid athletes and so many high-paid lottery winners end up broke so quickly, is because you make a ton of money, but you don't have any financial education. So what do you do when you make a lot of money? You blow it. Now, when you blow all this money you have a bunch of nice things, but you have no money left. This is the majority mindset way of spending money. You make a ton of money and then you blow it on a bunch of nice things that make you look rich, but they keep you broke. And so this is going to be a big no-no when you make $1 million. Now, don't get me wrong. I want you to own a nice home and I want you to drive a nice car and I want you to go on nice vacations, but I want to make sure you can afford it. That way you have cash to live your life financially free. So let's go into the second way that you can use your money. Now let's assume that you have this $1 million, but you're conservative. You don't like the whole idea of investing your money because you don't want to throw your money in the stock market and see this $1 million get sliced in half if the stock market crashes. So you want to be safe and you just put this money in the bank. This is how I grew up learning about money. I grew up in a traditional Indian house, and Indian people love saving money. It is like in our blood. And so Indian people make $1 to spend 20 cents and save 80 cents. Well, in the American culture, it is very common to make $1 and then spend $1.20 with lines of credit and credit cards and loans. And so Indian people are born with that saving mentality. And so what do? You make money and then you save as much money as possible, and you don't want to invest it because investing is risky. And so you build this huge savings cushion. That way you can live wealthy. Now, saving your money is better than blowing all of your money on nice cars and clothes, but it doesn't give you the full potential of your money because your money is just sitting there flat and is getting eaten away by inflation. In the financial world, there is something called the 4% rule, which says you take your savings and investments and you add it up, and then you live off of 4% of that a year and you adjust it for inflation. So in this example, I'm going to take a modified version of this 4% rule and say that you want to live off of just $40,000 a year, which is 4% of your $1 million you saved up in cash. If you live off of $40,000 a year, then this $1 million is gonna last you 25 years because now you're not investing your money. This $1 million is just sitting in your bank account, and every single year you're just gonna draw out $40,000. So January 1st every year you draw out $40,000 and you live off of the $40,000 for 12 months. If you continue to do that, you will be able to live off of your $1 million for 25 years. After 25 years, you're not going to have any more money. I'm assuming for the sake of this example that this $1 million is just sitting in your bank account and it's not growing at all, because right now savings accounts are not paying you anything. So if your $1 million is not growing and you're just pulling out $40,000 a year, then you will be able to live off of this money for 25 years and you will be living a $40,000 a year lifestyle. But this doesn't factor in inflation because, as you know, the value of our money doesn't stay the same. That's why $100 today can't buy as much as $100 could back in 1970, because our money is slowly losing value over time because of inflation. Now, if we factor inflation into this, and now you're not pulling out $40,000 every single year, you pull out $40,000 this year, and then you pull out a little bit more money next year, and then a little bit more money after that by factoring in a 2% inflation rate. Now, you're not gonna have enough money to live off of this $1 million for 25 years. You're gonna have enough money to live off of for 21 years. So if you want to live a $40,000 lifestyle, then you can expect this money to last you for 21 to 25 years, depending on what inflation is, if you have $1 million. Now, if you want to live $100,000 a year lifestyle, you can just adjust the numbers. So if your goal is just to save your money that you can draw cash out of, well, now you can do the math to see how long this money is going to actually last you. Now, this time, instead of saving your cash, let's say you have the minority mindset where you invest your cash and you want passive income, so you invest your money in the stock market for dividends. And I'm going to give you two different scenarios. Scenario one, you invest it in McDonald's, MCD, or you invest it in IBM. So scenario one, you invest all $1 million into McDonald's, and scenario two, you invest all $1 million into IBM. Now, look, I am just a random guy on YouTube, okay? So don't blindly listen to anything I say, and make sure you do your own research. I do not recommend that you take all of your cash and throw it into one stock just because of the dividend. This is just a hypothetical. Some companies in the stock market, like McDonald's and IBM at the time of me recording this video, make a lot of money. And at the end of the year, they have a whole bunch of cash in their bank account, and they just don't know how to invest all this money back into their business. And so what they do is they take this cash and they just give it away to their investors, people like you who invest in their stock. So if you go out and you invest in one share of McDonald's or one share of IBM, then you will get these passive income checks called dividends deposited directly into your account. At the time of me recording this video, McDonald's pays a 2.5% dividend, which means if you invest $1 million into the McDonald's stock, you will make $25,000 a year from your McDonald's investment. IBM, on the other hand, pays out around a 5% dividend yield right now, which means if you invest $1 million into IBM, you will make $50,000 a year in passive income from dividends. So you still own your investment, but every year you're getting a check from McDonald's or from IBM for doing nothing except just owning their stock. So you don't have to sell your stock to get these dividend checks. You just own the stock, and then every 3 months, every quarter, you are going to get a check from McDonald's or IBM. Before you go out and you start living this $50,000 or $25,000 a year lifestyle from your passive income, remember, the government wants their cut, so you gotta pay taxes. Luckily, dividend income has a lower tax rate because the government wants to incentivize you to invest your money and get this type of passive income, so they reward you with lower taxes. If you make between $0 and $40,000 a year in taxable income at the time of me recording this video, you have to pay 0% of your money in taxes. If you make between $40,000 and $441,000 a year in taxable income, then on your dividends, you have to pay 15% in taxes. And if you make more than $441,000 a year, then you are paying 20% a year in taxes on your dividends. At this point, you might be thinking, why in the world would anybody want to invest in McDonald's where you can only make a 2.5% dividend when you can invest in IBM and make a 5% annual dividend? Well, there's a little bit more to what meets the eye. Over the last 2 decades or so, the price of IBM stock has stayed pretty much flat, and over the last decade, the last 10 years, IBM stock has actually come down about 10%. So if you invested this $1 million into IBM, it hasn't really gone anywhere, and if anything, if you invested over the last decade, it has come down, even though you're making more money in dividends here. With McDonald's, on the other hand, the price of their stock has gone up 5-fold over the last couple of decades, and over the last decade, the price of the stock has doubled. So if you invested this $1 million into McDonald's a decade ago, this would be worth about $2 million, and if you invested into them 5 years ago, this would be worth about $5 million, even though your dividends aren't as big. So you have to understand there's a little bit more to what meets the eye, because there's more to investing than just the dividend price, which is why you do not want to make your investment decisions based solely on this dividend percentage. You want to look at the underlying fundamentals of the company, and you want to make sure you're investing in a company that's growing, that you believe in for the future, because if you do that, then you're going to make a whole lot more money than just this dividend price. Now, past performance does not predict the future performance in any way, but I just want you to understand this, because if you invested $1 million here versus $1 million here, then you are going to make less money in passive income for a little while here, but you could also pull some of your stock out and sell some of your stock and have some cash and still see the stock growth and still see the value of your $1 million grow while having more cash in your hand. In any case, with both of these examples, you have income that you can use to live off of every single year, and you also still have this $1 million nest egg. Now, if the price of the stock goes down, the value of your investment will go down too, but in general, you still have a big chunk of your investment just sitting there invested in one of these companies, and you also have passive income that you can live off of without selling any of your investment. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.